Welcome, everybody, to the Talk with Kiet podcast, where we connect people, ideas, and capital to make a difference. Today, on the last show of the year, I am so honored to have Lucio Biase on our show. Lucio is a serial entrepreneur and the founder of Thunder's Technology. Lucio and I today will talk about his extensive career and entrepreneurship journey, as well as entrepreneurship opportunities in capital markets. And being as humble as Lucio is, he will touch on a lot of the mistakes, the failures, the things you can learn from, what not to do as well. Lucio, welcome to the show.
Kit, it's really an honor and a pleasure for you to invite me, let alone those kind words. So thank you.
So I'm really excited to have you on as the last guest of the show for the year. And usually how we kick off is discuss your origin story. Because I also think that there's always great lessons learned and a great guidepost for people. So what is the Lucio origin story?
I don't know if you watched Family Ties in the 80s, but it's a lot like Alex P. Keaton. I have very hippie parents. My dad's a jazz musician and a violin maker and repairman. And my way of rebelling was going to an Ivy, playing sports, never touching a drug, and being infatuated with markets. Even, 8 years old, my big trade was Beatrice. I thought it was a great stock. And at my dorky school, we had right now people have the baseball leagues or football, things where you pick your own players. We would do that with stocks and compete. So markets always fascinated me, and starting businesses really fascinated me. And I guess that's my origin story. So I was very fortunate. Went to some good schools on rides and snuck into an Ivy for wrestling. And I learned a lot from wrestling, which I think transitions well. So I think maybe I'll tell a couple stories as a kid that I think relate to most entrepreneurs. Okay. The first one, it was a business that was in first grade, Miss Murphy's class. And, I, like most growth CEOs, you take credit for being a founder, but I wasn't a founder. My friends, they were cousins. They had this idea that they'd make a copy machine. So back in the day, people would use mimeographs. So I don't know if you remember, but you had like a piece of paper where there was ink and it was a mini printing press. And some of the meaner kids in the school, some of the sneaks would go to where the printer was and they'd find the exams because they had the negative space of the test that was run off the machine. So it was transitioning to photostat machines. Xerox, I don't think in 81 I was in first grade. I don't think they'd established the brand yet. People were still calling them photostats. So I looked at this and I quickly assessed that while Ari's outside selling it, Ian's inside the box making tracings. So I saw the model and I saw that other people could figure it out, and I elbowed my way in and I helped them run it, and we scaled it. So you can imagine first grade, we were on, I think the school was on 91st Street between Madison and Park, and we had a loft. And we had lights like these, big fluorescent lights. And the loft, because we were first graders, was maybe only 3 feet from there. So what I did was I got in the box and I saw we couldn't trace, and I cut out the top of the box. So now we can get light through. And the concept was we would charge kids, our classmates, $1 and make a copy. And we grew up in New York when New York was much different, and we weren't too far from 86th Street, and you had 3-card Monte salesmen. I don't know if you've ever seen that game. They would play it, and that's why when I grew up, living near a subway was a bad thing, because they'll rob you and jump on the train and be in another borough in minutes outside of the precinct or the jurisdiction. But now people want convenience because New York's so much safer. So you grow up watching these people sell the promise in 3-card Monte, and you realize that they have customers that are actually in on it, right? And you understand that whole sales process. I'm not saying it's something you emulate in capital markets, but it was something, even a first grader could pick up on. And what we did was we'd have people give us a drawing that we had already sketched, we had already traced, and we'd put it through the machine. And it was wild. And what was really crazy about it is the more disbelief that people had, the quicker they would draw something the easier it was to replicate. And then, of course, I had the idea of adding color. So we charge an extra $1 for voice-activated color. And we were doing real volumes. And when people figured out the way it worked, we put them on the payroll. I think Ari's dad, or Ian's dad, was an importer-exporter from China. So we give people a bronze figurine at the end of the year, and we kept at the end of the week, and we kept all the cash. Now, finally, it became such a phenomenon that Miss Murphy went upstairs and sat with me. And she's like, Lucio, this is amazing. How do you guys create a photostat machine? And this is an early lesson about dealing with regulators. And I said, Miss Murphy, what are you talking about? We're 6, 7 years old. Well, I'm outside selling the copies. Ian's inside tracing them, and vice versa. So I was very honest, and I still remain honest to the regulators. But yeah, so that business got shut down.
Now, talk about your second business, which is selling fruits. I think that's very interesting as well.
Yeah. So you're, as the French say, you're the son of your father. My dad is a very hardworking musician and violin maker and repairman, and what he does is very intricate. And just a work ethic. Maybe it's the Italian first generation work ethic, lavoro, the labor, as they say. So he used to drive us up to the family old farm, and he'd put a string around our neck with a coffee can so that we could pick with both hands. So my mom got the top berries, I got the middle tier, my sister would get the bottom. And we'd come back, and I grew up in Yorkville, so 79th and York, and we set up a stand. And we had a little cup, and we'd sell the blueberries. And this was, again, in the 80s. And, that whole farm-to-table, locavore, organic wasn't that big yet, but people appreciated it. So it helped me understand brand, the importance of quality, consistency, and really the fact that, people, you talk about it, lifetime customer value, but the most valuable person you have isn't necessarily the prospect, but the actual customer, because they'll come back. So my mom tells me that, when we were in our 30s, women would still ask her, when are your kids going to sell the blueberries again? She's like, please, they've graduated. My sister deserves the credit. Yale twice, Columbia a couple of times. They're not selling blueberries anymore, but it was something very tangible, right? The margins were great. We had a product. It was a short season, and you knew you only had one shot at it. So I think, I think that gets taken for granted when you have the benefit of a salary. So, I think also chess, we were national champs. They wrote a book about Josh, who is a year behind us, searching for Bobby Fischer. I couldn't afford to go to the away tournaments, but I would go to the local tournaments with the team. Yeah. And we dominated. And, it's funny. I left that team. We had a very traditional Russian coach. And because I saw something morally that we were doing wrong. And what we did, he would retard our ratings, because at nationals we would play in nationals we would play against similar rated players in the round robins, and that's how we got the team points. So when I figured that out, I approached the coach, and then I couldn't play chess anymore. But the nice thing about chess is it's a humbling game. There are always people that are better, and the way you improve is by learning from your mistakes. And that's one of the things I love to ask entrepreneurs, because you can quickly tell if they're experienced, if they're introspective, if they're honest. And so I like to ask entrepreneurs, what's the toughest lessons they've learned the hard way?
Yeah. Now, you started your career in capital markets. I think you started in Lehman, Credit Suisse, and then you were part of Marathon Asset Management. What inspired you to leave that behind to launch your first startup?
Sure. I was always fascinated with markets. If you count pre-med, I did a triple major, wasn't sure what I was going to do. Ran a boat for a year, and I found myself watching markets when I wasn't fishing, and it just always infatuated me. Coming from the background I did, and our education was more in economics, less in finance. People that graduate Wharton have that advantage. So I went through the campus recruiting process, and because I was off sequence, Columbia let me defer it for a year. I took the first job offered, and candidly, I didn't know the difference between front, middle, and back office. So if you can imagine it, in 1999, I took a job in emerging market credit risk at Lehman Brothers. And we had paper files, and that's how we judge our exposures, right? It was nuts. And you'd hope the paper file wouldn't be lost and that all the trades would be in that file and stuff like that. And it was me and a VP named Dave Sackett, brilliant, kind guy, and as I've worked with more people, I realized just how nurturing he was. But two people, relatively junior, responsible for all of emerging market credit risk at what was a large bank at the time. And it was a baptism by fire, right? You have to look at it in a context. You had the Russian, the Mexico peso crisis, the Russian debt debacle, and we were a year after East Asia blew up. And it fascinated me. Why were we waiting on money, millions from Chase on this trade to pay JP Morgan? Why wasn't this all netted off? And that's what my last startup did, the last startup we exited from. But that's what planted the seed. And when I said it was a baptism by fire, the beauty of credit risk, even though you're not an earner and you don't get paid as an earner, is it was a great introduction to capital markets for me. What products were offered by the banks, where the real risk was, and what money they made off of it. And then, muni derivatives were a huge business. And, we can talk about that morality later in maybe a different podcast. Yeah. But it showed me what the different desks did, what the different functions of the bank were. And while maybe it wasn't as lucrative as other positions, in hindsight, I don't think I could have had a better introduction to that. It's funny, we talked about introductions and timing. I have a good friend. He was Margaret Thatcher's pen pal in 5th grade.
No way.
Rob Hyman. He's changed his name to Ryman. Because when Margaret Thatcher died, I had a little trouble finding him. He went on to become Harvard's class president, but one of the kindest, brilliant, just great guy, fantastic chess player. And, Rob and I were good friends. We hadn't seen each other for years. And I'm going through my career and what I did in finance. And he said, "Oh, Luch, you're the Forrest Gump of finance." And he was dead right. I think that's a good way of summarizing it. I've been fortunate to be in the right places, maybe a little too early, and purely by accident. But, and the joke with my father, my jazz musician dad, is once he understands what I do, I usually switch jobs or switch companies. So maybe a long-winded answer to where it started out and the journey, but that's how I wound up in markets. And then, I started out in the analyst program at Lehman. I was fishing one day. I would fish on weekends. The middle office gave me that freedom. And it was the associate outing day, if you can imagine that, like 1999. Yeah. So they chartered boats out in Montauk, and I was the mate on the boat. I put myself through school fishing. And if I could hire commercial fishermen, ones without drug problems or a lot of debt, to be in startups, that's the ethic you need. People that stay on deck 20 hours a day and understand that you have expenses, and only after expenses are paid, maybe you get a share. And you want to keep the crew light and with consummate people, so you're not diluting the pool. And that ethic kind of is lost, right? Because people have the benefit of a salary, and it's really, we can talk about this later, but the jump from working at a company to starting your own thing. But I remember I came back and I was interviewing at Goldman, and a lady asked me, are you ready to sit at this desk and eat all 3 meals and then go home with the car and not see your family? And she didn't understand what commercial fishing was. So I said, "Are you kidding? 3 meals a day with 3 meals a day, you get to sleep in your own bed in a climate-controlled, safe environment? Sounds fantastic.
Where do I sign up?"
Yeah. So, of course, it didn't go well with the junior person, but the senior people loved it. They understood the perspective.
Now, what are some of the lessons learned you have from your first startup?
Oh, that's great. Ask me my own question. I think the toughest lesson I learned there, and I remedied it with the second startup, is I took too much capital from one party. And when you take that much capital from a party, even if their intention is 100% aligned, they can be wrong 10% of the time. And at a startup, you can't afford to be wrong that frequently, right? It's like a single elimination tournament. So the way I remedied it was at my next startup, I made sure I capped any investment from any particular person at 250K. I figured maybe that's what I could earn back in a year. And I figured it was too much to risk, right? And in that, you think about it, you have people that may know aspects of the business better than you do. And I talk about taking investment from people you can only dream of hiring. Because if they've invested in you, they almost pay for the privilege of working with you or for you.
Yeah.
Because on a Thursday night, I could, and Kit, you've probably seen me do this. Kit made a modest investment in my latest startup. But the concept is you text them with a question you really can't answer on a Thursday night or Friday night. You'll get an answer that night or the next morning. And I don't know what it would cost to have that many people of that level working for you. But and the other thing is just the math of it, right? So let's say they're wrong 1/10 of the time. And I know that it's a little correlated, right? Because we have similar experiences. But the fact that everyone's wrong, if you ask 6 people, that's one in a million.
That's right.
10 to the 10. So what it allows you to do is to get to answers to questions quicker with more certainty.
That's right.
So in the last startup, I think we have in our seed round, we did something like 31 investors, of which 29 have real capital markets experience.
Wow.
It's important. But so that was the toughest lesson I learned, the hardest lesson I learned with the first startup.
Yeah. Now talk about that sales process. You sold your first startup, right? It's around like 20.
Yeah, I had a modest exit with that one. It was funny. My mom, they live in Yorkville, a neighborhood east of the Upper East Side, and every now and then I'd crash at their house. I was living on venison and ramen. Luckily, I'd usually find a deer every year. I'd given up a VP trading job where I wound up being principally responsible for the integrity of the book, meaning the pricing of it and the risk measures, and also the funding of it at Marathon. And maybe we should retouch on that, because that was, I think, an important thing for entrepreneurs is to be at a startup before starting your own, because you learn less the hard way, but it's a real culture shock. No, I'm sorry, Kit. What was the question before I went into Marathon?
The sales process, selling your first business.
Selling business. Yeah.
Yeah.
So that's right. So I'd get dressed up. I'd wear a suit. My mom would tell me, "You look like $1 million." I'd be like, "Yeah, I'm shooting for 10." And that was a trying experience. So I knew nothing about early stage investment, and I was very fortunate. I was at a hedge fund where in my mid-20s, I could risk a few $1 million on an option premium without raising an eyebrow, because of the payouts. The expected payouts outweighed what I spent. And the odd thing about it, unlike research, is you only have to explain your logic, unlike academia, when you're wrong. And I really love that.
Yeah.
About trading and entrepreneurship, that if you understand something better than anyone else, there's an opportunity there, whether it's trading or building a company. Sorry, kid, I'm distracting myself.
No worries at all.
It was the sales process. So, but I think there's a backstory worth touching on. So I'm trying to raise $1 million at a $10 million pre, and I know nothing about this. And there was another fintech, and these guys were great, and addressing credit derivatives, and they actually won. We had 2 different approaches. They did split coupons. I had this concept. It was early, a little too early. It was a smart contract, and this is in 2005. So the credit derivative market was, let's say, $12 trillion, 14 banks, 40% of trades went unconfirmed for 60 days or 6 months. I can't remember the exact stat. And I started a company to address that. Sorry, too many distractions. So anyway, I'm trying to raise $1 million at a 10 pre, and I have no idea, and I can't believe how slow it is. And the company that won, that got the bank consortium together and appreciate the nuances and strengths of a bank consortium, they used a split coupon instead of a distributed ledger and a smart contract. And this is back in 2005. And I leveled with them. I'm like, come on, it's $1 million. Like, how is this taking so long? Either blank or get off the pot.
That's right.
And it was Mazi Dar, who I'd love to introduce you to if you don't know him. He'd probably be an even better guest than myself.
Yeah.
He said, Luch, I don't think you understand how early stage investment works. And he was absolutely right. So that's actually why I named the company Thunus, because it's Latin for fast. It's also the family name for tuna. So Thunus is bluefin tuna, the fastest of the fast. Thunus obesus, big eye, the ones with the high fat content, they're prized by Japanese markets. So anyway, so that's why I named it Thunus. So I couldn't do it. And I partnered with a VC guy who was a Wharton grad to help me raise the capital. And within a month of him partnering, I got a letter of intent for a $12 million investment. I was only looking for one at a 12.5 pre. I couldn't believe it. And it's because I wasn't conversant in how to explain the opportunity, the business. I was lost in the weeds, and I'm still guilty of that. And, I was so excited. I wasn't going to go on the annual hunting trip because I was living on fumes. Like I told you, a Christmas gift for my sister, venison and ramen. And I traded in $10 and some miles, and I went hunting in California. And the critter Karma Kitty caught up with me. One of my guest hosts shot me from 6 feet away with a shotgun as we were approaching this pheasant field. So luckily I had the other thing to obsess over. It was 6 months of uncertainty, not knowing if the deal would close or the wounds would close. And it was Knight Capital was the investor. And, my Cobra had just run out the day before the trip, if you could believe that. Wow. So here I am in rural California, ironically a town called Paradise, worried that I'm going to bleed out. I lost my posterior tibial artery. You usually have like 45 minutes. We have 2 family friends. One of them is Uncle Jesse. He bought me my first shotgun at age 13. He ran triage at 9/11 when they were expecting survivors. He was the Special Forces field doc back in Vietnam. So he taught us, and if a cop got shot in New York City 9 out of 10 times, it was Uncle Jesse who would stitch him up. So he taught me how to dress field wounds, and that saved my life and saved my leg. But for 6 months, I didn't know if the wounds would close or the deal would close. And luckily I had the other one to obsess over. So I remember going to the board meetings early at Knight Capital, schlepping out to Jersey City from Manhattan, and taking my duck hunting jacket because I was still hooked up to machines, something called a wound vac. And I'd get there early, so I was masking the severity of the wounds, but I wasn't going to let losing a leg stop me from closing the deal, or luckily I kept the leg, or launching this product. And I kept the machine under the wound vac, and later they thought that I was just flatulent. They didn't realize that I was hooked up to a machine. So then the great irony is TJ, Tom Joyce, is the CEO of that company. And after the meeting, I put the wound vac to the machine. And what it does, when you have an open wound like that, the biggest fear is infection. And that could happen from it being moist, or having dead tissue, or being exposed to the elements. So you have to imagine how excruciatingly painful having a large open wound is, getting negative pressure, they call it, or suction, where everything's getting sucked out, and then the tissue grows into the sponge. And every 2 days, you rip it off with all the nerve endings so that I could grow enough substrate that I could keep my leg and cover, because I didn't have the vasculature for a muscle flap to have a skin graft. So here I am after the big board meeting. They're proceeding. I'm very happy. We've got through most of the terms. And I go into the bathroom. I have the machine on me and the tube coming from my leg. And sure enough, TJ stands at the urinal next to me and sees the severity of the wounds and just laughs about how hardcore and focused I am to get it closed. But yeah, I worked for them for a year. And then it's a longer story, but then they took me out of my interest. We were a little early. I mean, we saw the credit derivative thing happen before it happened. And the idea of one of the patents is this idea of a distributed node. So the concept is, instead of having a chain of intermediaries on a derivatives transaction, like I bought protection from this person, sold it to that, the patent, you can look it up under my name, was to minimize the number of vectors between the nodes. And if you look at it, that's basically a distributed ledger. So the concept is, if you can create a fungible product where the contract rate moved to match the market rate, you got rid of a creditor relationship on collateral, you had realized P&L, and no matter what the tenor was, you had a maximum potential exposure of 1 day. And 15 years later, they did that with market accounting in clear derivative products when you have the daily true up. But it was a little early, and it gave me some financial freedom. It wasn't a giant exit, but for me it was great. And I bought a boat and I ran back to the Turks, where I was that captain that year, and I thought about everything I did wrong. And luckily, it was a long trip on a slow boat. And I came up with the idea for my second startup, which was Locked Markets. And the concept there was, why, if there's a monopoly in the space, are only 10% of derivatives exposures, like in the swaps market, getting addressed? And what I saw was that people had trade-based terminations. That's what compression was. And, trading platform systems aren't built to terminate trades, right? The other thing is that they can only address a subset of parties that didn't have accounting issues when they realized P&L. A subset of products that are readily available, where you have readily available marks, not too much debate on the valuation of the product. And then a further subset of positions where they weren't deep in or out of the money, because then you'd have debates on the value, the MPE of the curve and the collateral. But I won't go into those details. So I thought, if I could only get the largest banks in the world to trust me with their biggest positions and their exposures, then I could figure out a series of trades to layer on top, net and diversify exposures, and optimize their market risk in the most efficient means possible, as a function of not only where and how they're registered, a bank or a broker-dealer in Europe or the US, but also what their leverage constraints were, whether it was risk-based or position-based. And my artist friends in New York made fun of me because they looked at it as performance art. How the hell are these banks going to trust you with that data? And it took 3 years, and they actually did. And then once we showed them results, it took them 2 years to believe them, because they were orders of magnitude better than what they could do bilaterally or what the incumbent was providing. And it was great. We changed post-trade markets forever and for the better. 2 companies adopted, and this maybe brings into IP, which I'd love to talk about. 2 companies, and they wound up suing each other for IP theft. We passed on the suits because we were closing on a World Bank investment, which was super helpful. If anyone's in the capital markets and they touch emerging markets, get the IFC on board. I mean, they were so kind. This guy left his family for 3 weeks to roadshow me through Asia.
Wow.
I mean, you think about your first meetings, and I'm trying to get a meeting with someone's former roommate's cousin who may be in ops on this desk. And then they wrote my visa for China. And is it CIBC, the largest bank in the galaxy? That's what they call themselves. They write the letter and they said, we're deeply concerned with the systemic risk you cause. We'd like you to talk to the founder of this company to lower the possible impact of your failure. By the way, we made an investment. We'll attend the meeting, and we own X% of your bank. And that was the pinnacle of my career at that company. I remember it's a company of 400,000 people in China, mostly quantitative based because it's a finance company.
Yeah.
And one thing that impressed me about China was the equity between men and women. The general of trading, they didn't call her the head of trading, but it was a woman's role. And
wow.
14 of them lined up, and we started talking about it. And the representative from the IFC who traveled with me, Farouk, great man, he sees me debating their head quant. You can imagine the quant level of a finance firm of 400,000 people in China, right? Farouk's like, stop arguing with him. I'm like, no, trust me, this is a good thing. And he looks at me, he goes, how? I'm like, well, either he respects me enough that he wants to change my opinion, or he respects me enough that he realizes he may be wrong. So we got through the mathematical debate, And he became a believer. And the general of trading said, okay, how long is the agreement? It's like, it's a 3-page NDA. And she said, no, the sign-on agreement, 11 pages, here it is. And that's the lesson I learned the hard way that I try to instill upon my colleagues now. I had a meeting with Morgan Stanley, and they were one of the first bank at my first startup. And they were one of the first banks to realize that you need to collateralize buyers of protection, buyers of CDS. I'll give you an example. AT&T was trading really wide, 300 basis points a year. So guys, look at this as, I'm going to say insurance because that's a very heavily weighted word, but credit default swaps. You would pay a certain spread to LIBOR, to the floating rate at the time. And if the company defaulted, you would get paid par minus recovery. So, you get paid, par minus recovery. So if you bought protection at a high premium and then the credit rallied from 300 to 100, the person who wrote you that protection has a contract that has a 200 basis point annuity, right? So it's important that you continue to pay. So they were one of the first people that understood that, right? And they were also, because they understood it, they were one of the first believers in this concept of a contract rate that always moved to match the market rate, because at the end of the day, the contract's valueless, right? You get rid of that creditor relationship of collateral. So I'm sitting with Neil. He was the COO of the credit desk. And he said, this is great. Let me bring it to the CFO. I was like, oh, the CFO of credit? He goes, no, the CFO of Morgan Stanley. So you talk about lessons you learn the hard way. I didn't have a user agreement ready for them. I was pitching banks without anything for them to sign. I mean, in retrospect, it's crazy, but you have to be rigged and ready. Like fishing, you only have one shot. That marlin's going to come up. And if you don't have the bait rigged and you don't know how to throw it and you haven't practiced it 50 times, you just wasted a day. You just wasted all that effort. So I remember waiting because they gave me cash and resources at night to try to get the user agreement done. And I didn't have the freedom to use outside counsel. So I literally parked myself with the wound vac in the CEO's office until he'd give me the resources which I needed. And Tom stayed with me the whole night and we cranked out a user agreement. Ironically, I later hired Neil into my last company. But yeah, these are things you learn the hard way that hopefully people listening to this podcast won't.
Yeah, no, I mean, when you think about like derivative market, I don't think people realize how big it is. Like it's a few $100 trillion. When you talk about rates, credit, equity derivatives, all combined globally, FX, etc. And the opportunity to build efficiency into these markets is still there today. Like, talk a bit about like your thesis and view around just entrepreneurship for capital markets.
I think there are 2 points there. The first point is maybe anecdotal. I was hanging out with someone and they asked me what I did. These conversations happened maybe a little earlier in the conversation in New York than otherwise. And I said, we have a $12 trillion market with 14 participants, the big banks. And 40% of trades go unconfirmed, like I said before, 60 days or maybe 6 months. I can't remember which unit. Meanwhile, video games at that time were just getting, over the web. And they would hook up thousands of users with risk, like your life force, and P&L, your score, in real time, right? With nothing but pride at stake.
That's right.
So I was very fortunate to be introduced to one of the 4 founders of Rockstar Video Games. And we hit Wall Street, with him designing the front end. And you think about, all the aspects of what they do. And I think it's just a good example of how advanced, other things are outside of our microcosm of Wall Street. I mean, we were speaking earlier about systems and how people are often wed to legacy systems. And I think one of the most beautiful things about starting your own company is you have, the freedom to choose who you work with versus being stuck with people maybe you didn't hire or wouldn't choose to work with. That's why I didn't stay on the sell side too long. What you work on and what you prioritize. And I think by virtue of that being a smaller group where you really get to choose who you work with, we can be a lot more nimble with less budget and sometimes even less aptitude, right? So it's also difficult, and I've seen companies take this approach. One was competing with us. You can't go to a bank and say, we do what you do better. You're never going to sell them on that. And candidly, if it's just a matter of doing it better, they can hire better people, right? So what we were very fortunate with this compression company on markets, locked markets, is that we could explain that we got a better result by virtue of having better information, right? If these large banks trust us with their pricing and their actual exposures, they would never trust their competitors. And to your point, to the scale of markets that are measured in the hundreds of trillions with billions at risk, right? But if they can trust a third party with their data, a third party that won't take their data and exploit it and trade, that won't take the data, find a set of trades that are erroneous. We were really fortunate. I have a great CTO. He's with me at this company again. But he cut his teeth building program trading in its early days at Susquehanna. And I remember the swaps dealers would ask us, how can you deal with the volume of the swaps market? Well, he'd do it in an entire year's volume in an hour. We didn't have a single trade break or outage. And you never get a second chance, especially like with wrestling, with chess. You blunder, you're done, right? You're stuck. So it's that same thing. You got to learn from your mistakes, but you can't err operationally. Sorry, kid, I went on a tangent.
No, not at all. I think you answered it quite well. So tell us a bit more then about Thunus and what you guys are tackling.
Sure.
And especially the evolution of how your ideas evolve from your first, your second, to now your current startup. Like, what are some of the core principles you utilize to come up with ideas and launch startups?
Yeah, I think to your point about inefficiencies, legacy systems, how can you work with them and for them, right? How can we apply newer fields of math or different approaches to make things better? And you always have ideas for startups, and I'd like to touch upon this in this context. When people are debating leaving, I mean, my parents thought I was crazy to leave in my 20s as a VP of a great hedge fund, really smart people. I joined when I think I was one of the first 10 or 15 hires, 200 million, 250 million under management. I left when it was 6 billion. And, they raised not capital for the business because they were wealthy enough to run the business, but they raised capital for investment. What they did, which was really smart, was they would not inundate an asset class with capital. And it's like adding different products, and at first they were very modest. We were in Grand Central above a steakhouse. And if there were sewing machines instead of laptops in front of us, they would have closed us down as a sweatshop. But I joined them in the spring, and the windows room just smelled steak all the time. We couldn't keep up with the people, the heat from the monitors or the servers, right? And he used that as a sales tool to get the funding he needed before he moved to the building on Fifth Avenue overlooking Bryant Park with all the terraces. But I learned a lot, and I said this before, but it's nice to work at a startup first before you do your own. I'm sorry, Kate, what was the question?
How you evolve, ideas around like startups you launch, like from the first, the second, to the third.
Yeah.
Like, what are some of the core principles you utilize?
Yeah, so I talk about the 3 Bs. So my parents thought I was nuts to leave that position and that money. And I was very fortunate. I wound up bidding on an asset owned by the government, and it was right. And that gave me the freedom to start my own company, the financial freedom, because I couldn't afford to otherwise, right? And there are the 3 Bs. There's the brains. You have to have an idea that can justify you leaving the salary and changing the career, right? You have to have the bravado, the faith in yourself to do it. And then unfortunately, you need the brawn. You need a partner that can keep people honest. And that's why I believe in these broad syndicates. And later, when you're taking capital, I did this at the last startup. I did a secondary, and I sold a bit to a really great firm, the largest derivatives exchange in Europe, Eurex, and they were great partners. But the benefit of having them in the cap table is that you have someone with the balance sheet. Maybe that's the fourth B. But if you get an unsolicited offer or something that isn't really market or fair, they'll say, you know what, at that level, we'll take it. So I think those are maybe the four Bs, right? So the brains to have an idea, the bravado to risk it, the brawn to keep people honest, because there's unfortunately no honor with thieves. And I could tell you too many stories of IP thievery. And, if I could, other than change risk and lower systemic risk, we could change the treatment of IP theft. If we would just have so much more innovation. And I think it's one of the few things you could steal where it's a civil offense. Imagine if you're a startup, you risk it. You go without salary for years. You get friends to do the same. You talk to someone with the right intentions and they rip it off. Right? It's just horrid. Do you think they would rip it off if it was treated like any other type of theft? Shoot, give the DAs in New York 10%, do it on a contingency basis. They find the criminal, they stole the things, when they're revealed to them in these things, everything checks, and the city gets 10% of the settlement. There'd be so much more innovation, because it's really difficult, and they try. So the way I mitigate it is I don't come to market until it's complete, right? Until it's really bulletproof. And the question isn't, can we do this? Can I give this to Joe to do? Wow, how can I use this? And if we could get them the first time they see it to ask what it costs, then we did our job. Yeah. But I think IP theft is a real, and in the US, they've adopted this thing where, you can't patent processes, which Europe did, right? And the next innovation in trading isn't going to be a product. It's not going to be a machine. It's going to be a process, right?
Yeah.
And so anyway, with that long background, I remember I was debating between three different companies, and I had a meeting with an old boss's boss. He ran rates at Morgan Stanley, and I pitched markets to him. And he said, "Luch, can I get a quant in here?" And I figured it would be a foreign-born PhD around my age. And in walks Dexter Senft. And he's a stalwart. He's the guy that figured out how to tranche mortgages. And back in the day, they give like a structured product innovation of the year award. He won it twice, champion bridge player. And that meeting had me focus on L markets, not the other things I was thinking about. And I mentioned that because what I did at Thunnis, or we try to do, is only develop three things. If you have a good tech team, a good legal partner, and you have enough capital, you can kind of skip the seed and the early friends and family, and you could get a growth CEO earlier in the process, and you can have more say in it. And I think that a lot of investors don't realize that true CEOs, good CEOs, want the best person in that position. It doesn't have to be them. And it was wild when I monetized my first chunk. There's a difference between raising money at X valuation and monetizing at Y valuation. All of a sudden it becomes real. And you realize that what you built has wings. And I saw this with like each stage of the company, or the companies. So the first thing, I was happy to get funded. And my biggest moment was I walked by a room with a whiteboard that wrapped around it, right? And I saw this beautiful system which did a risk check, trading, matching, reconciliation, compression, soup to nuts. And I realized it was my company, and I didn't have a single brushstroke of it. And that felt great, right? Then my second company, I pitched to the incumbent under NDA. And the two guys that ripped us off sued each other for ripping each other off. But so you can imagine how that went.
Yeah.
So, 3 2.5-hour meetings, they flew over. One of them said, "Wow, you just rendered our $100 million acquisition valueless, blah, blah, blah." They offered me a job to work for them. I had a chip on my shoulder. I wanted to see something through from concept to reality to hopefully market standard. And that's what we were able to do at the last company. So what we do at Thunnis is try to limit it to just three things and build it to the point where we can do a Series A or launch and go to growth CEO earlier in, because then the growth CEO only has to worry about three things: a clearly articulated execution strategy against which we can hold them accountable, sales, and product development. Everything else, the old decks, the code, the product, build, sell it. How are you going to bring it to market, and how are you going to improve it, right? So that was the theory. What happened in practice? So there's three things. There's something where we crowdfund wildlife reporting bounties. That's a longer story outside of capital markets, but something I care about. The other thing was my lead investor in my last company was going to buy me out. When push comes to shove, they didn't have the capital. And like any wrestler or chess player, you learn from your mistakes. And I realized there wasn't a borrow market for private equities. So that's PALS, the private asset lending service. That's the second thing. And then the third is liquidity lock, which I'm most excited about. And what that is if you could trust a third party with your information, instead of finding a portfolio of trades to layer on top, keeping market risk neutral and optimizing the way you express it, let's do something similar. If you can trust this party and they have this demonstrated ability to find trades you couldn't for trade execution. So you want to fundamentally change the way market risk is transferred. Now, what I didn't anticipate is, I have a couple of clients from the old shop, but the people I've been working with, they love liquidity lock so much, they've left Thunnis and gone there. So PALS and Modernize are kind of sitting in the background. But that's what we try to do at Thunnis. And it's fun to have an addictive problem in a market of these scales.
So you actually mentioned a good point that I want to highlight to the audience in terms of understanding what you're good at, understanding things you like to do, and then trying to build the team around you. Because you mentioned about going out and finding a CEO. Like, how come you're not the CEO? Like, talk about that thought process to the audience, because that's really critical.
I'm going to tell you another first grade story, ironically at R.A. Baston's birthday. So anyone who grows up in New York or is in New York, maybe with kids, knows Dog Hill. That's where everyone goes sledding by 79th Street.
Yeah.
And at the bottom of the hill, there's a little flat area, and we were playing baseball. Not baseball, we were playing, I think, wiffle ball or softball.
Yeah.
First grade. And Ari's stepdad was a bond trader. And I didn't really know what it meant. I knew there were bearer bonds and the little series EEE treasury bonds I had. But I didn't know corporate bonds. I knew Milken, kind of, but this is the 80s, right? But just a great presence, right? Really like a guy's guy. And everybody wanted to play shortstop. So I was playing second base and we changed positions. And I said, okay. All right, Lucio, you're in your shortstop. First ball gets driven through me. I didn't even react. Like, I just erred. Second play, one ball goes to the next field. Third play, I bobble the throw to first. I said, all right. I asked Jay, can we all come in? Jay is our stepdad. And I go, Jay, take me out. He goes, what do you mean? He goes, and I said, well, 2 plays that came to me, I bobbled them. I'm not the right person for this position. Put me back in second. I won't miss the throws. And let someone else try shortstop. And he said, Luch, but everybody wants to be shortstop. It's like, yeah, but we're not going to win that way. And, it definitely sounds less than modest, but that's the way you got to approach it, right? And it infuriated me. We hired a salesperson in Europe at the last shop, and I'm trying to keep it as anonymous as possible. He didn't make a single sale and cost us a client, demanded a high base salary. He was introduced to us by one of our investors. You think someone would have the decency a 6-year-old has to say, you know what, take me out. I'm not in the right position. And if you can't recognize if you can't separate yourself as an employee and as an owner who holds the equity, or you can't look at yourself critically enough and say, you know what, I'm not the right person for this role. And it's just so selfish. And unfortunately, it's ubiquitous. I think we live in a world where there are a lot of people that in finance that spend time at banks because of constant budget cuts and layoffs. Every bank has a different verb for it. It's bred a bunch of attritionists. So they do what they do not to get fired, but instead of taking the risk, excelling sometimes and being encouraged to do that, right?
Yeah.
And no attritionist is going to say, I'm not the right person for this role, take me out, right? And yeah, it's a difficult thing. And maybe, can I talk about a couple of stories everybody reads that relate to entrepreneurship and nobody looks at it in that context?
Yeah, most definitely.
Okay. So the three stories, one is, love him or hate him, is Christopher Columbus, right? He came up with an idea to facilitate trade, couldn't get funded. So like many entrepreneurs, he gets funded by a sovereign wealth fund,
That's right.
Spain. And maybe he didn't reach his target, but he didn't admit he was wrong. And he actually got paid a vig or a commission on everything coming from that port that Spain could tax. So a very successful entrepreneur. He saw things a little differently and got people to try it, right? And, I also want to talk about like the levels of responsibility when you start a company, but hopefully I can get back to that. The second one is, let me see if I can do this chronologically, is The Pearl by Steinbeck. So there's a poor pearl diver, modest pearl in La Paz, Mexico, and his son gets bitten by a scorpion. And he goes and he dives a little further away from the fleet, a little differently. And he comes up with a black pearl of immeasurable value. And, he brought his like low grade tiny pearls to the doctor. They laughed at him and wouldn't treat him. So I figured, okay, if I could just, get the wealth and he can save my baby, right? So dove in a different place, a little beyond the range. And then his problems began when he had this pearl of immeasurable value. And to be very candid, that's what happened at L Markets for me. The second we printed our first trade, we were at earnings. And that's rare, right? But pure tech can do that. You have machines doing the work, not people, right? And, we had 10 million in the bank, 10 employees and 10 customers. The investors got very aggressive. I joke they pulled a Tesla or a Apple with me, but they only got it half right and didn't hire me back. But luckily that company was sold to a better capitalized, a better run, a better connected company. So my employees were in a better position. The third story is the story of Kontiki, Tor Heyerdahl. So Tor Heyerdahl somehow avoided the stresses of World War II, was living with his first wife in Polynesia, and saw that a lot of the plants, particularly the cultivars, were very common with what's in South America. He couldn't understand that they couldn't float across there. So he thought that maybe Polynesia was settled by Peruvians or South Americans. And he looked at the technology, and what they had were balsa rafts, maybe with a sail. So like most entrepreneurs, and again, not told in this context, he got funded in an oak paneled room in Midtown, the Explorers Club. Now, here's the rub. I'll talk about the responsibilities of entrepreneurship, but he built a team where they risked their lives, not just their livelihoods, to prove an idea. And that's what starting a company is. I'm asking people to take that jump and risk their livelihoods and their careers, right? Behind this concept that, yeah, maybe these potatoes came from South America, right? And he got them to do it, and he proved them right. And he kept the team together, no mutiny. Can you imagine not knowing if the balsa raft, just huge trunks of balsa lashed together with the lashings they had at those times, going across the Pacific without EPIRBs, without SATCOM, just an expected time of arrival based on currents, which they couldn't even measure, and winds. But that's the third story of entrepreneurship. And I think that relates to building a team and keeping them motivated and keeping everyone focused on what has to be done, the direction, what you're trying to prove. So I asked if I could footnote it, but I think there's responsibilities of an entrepreneur that get heavier And, I really admire the people that can do it while having families, because the amount of time it requires, I don't understand how people find that balance. So, I think the first level of responsibility is to yourself when you leave the firm to start a company. The second level is when you take people's savings to prove out your idea. And this is what they've worked for, what they've earned, what they've paid taxes on.
Yeah.
And you really owe it to them when they risk their savings on your concept, right? The third level is when you have employees, and these employees risk their careers to prove out your concept. I'm not talking about selling across the Pacific on Balsa, but maybe if we could just get the largest banks in the world to trust us with these exposures, right?
Right.
And then the fourth level, and I haven't done this yet, is when they start having families. So if you thought you felt responsible for their livelihoods and their careers, now they're starting families banking on the fact that this company will perform and continue to perform. And that's just the levels of entrepreneurship and responsibility. So I think, first yourself, then the investors, then your employees, and then employee 2.0 when they start growing their families. And
that's amazing insight, Lucio. Thank you so much. Thank you so much for being on and sharing so much beautiful stories and insights to the audience. Now, usually what we do in the ending is really asking the question back to you is, what type of institution and people you want to connect to, and how can people help you?
Well, right now, I think what would be most helpful is any traders, buy side or sell side, that are frustrated by a lack of liquidity. We've designed a platform where people can instruct it as they would a colleague. For the banks, it's beautiful because they can monetize information they have without ever sharing it. And their most valuable information is their knowledge of price. And for the buy side, you can move size without ever alerting the market of what your intentions are. So, when I was on the buy side, the etiquette was if you gave someone a size and they quoted you a tight market, you had to take one side or the other, otherwise they put you in a box. So this gets people kind of back to that. And unlike electronic trading, it doesn't squeeze dealer margins. And, money supply has grown exponentially, but the amount of liquidity the banks can provide, whether by virtue of the number of desks or the ticket sizes, haven't grown in kind. So it's an optimization that would really help people move size or find liquidity in places where there isn't as much volume.
Fantastic.
Portfolio trades.
Thank you, Lucio, for being on today. Thank you to the audience for your continued support. For those of you that are on today, thank you for listening, and hope you find a lot of the insights as I did come from Lucio. Happy New Year to everyone. I hope you all have a great 2024, and we'll speak again next year. Thank you, Lucio.
Well, really flattered to be on. Thanks for the time.
Bye-bye.